Imagine you're standing on like a sprawling used car lot. The sun is just beating down, and you are gripping a cashier's check for $10,000.
Sounds incredibly stressful
Yeah.
already.
It is. You're looking at the shiny, freshly waxed sedan, and you know for an absolute fact that the person selling you this car, the dealer with the really bright smile, knows a deep, dark secret about the engine that you do not know.
Yeah, they have all the cards.
Exactly. And yet you are seriously considering handing over your life savings. Like, why on earth would you ever do that?
I mean, it completely defies basic logic, right? If you know the game is totally rigged against you in terms of information, the only rational move should just be to walk away entirely.
But we don't. And that is exactly what we are getting into today. Welcome to this custom-tailored deep dive. We have taken this massive stack of your sources, lecture notes from DSE and JNU, advanced microeconomics papers, historical data on exam patterns, and, some of our own analytical research, and we synthesized it into a single cohesive mission.
Yeah, because we know you are in the final stretch of your master's level revision for the IES General Economics GE-01 Paper 2 exam.
Yep. So today we are focusing exclusively on consumer demand theory, part 2. That is risk, uncertainty, and asymmetric information. We are going to explore exactly why you might buy that used car and, well, why markets don't just instantly vaporize the moment someone hides a secret.
Which they probably should, theoretically.
Yeah.
But we are leaving the safe, completely predictable world of basic indifference curves behind us today. I mean, you already know how a consumer behaves when they have perfect visibility.
Right. You buy an apple, you get a set amount of joy from that apple. Simple.
Exactly. But today, we're tearing up that script. We are entering the murky, chaotic reality of the actual economic machine. We're looking at what happens when outcomes are essentially just a roll of the dice, and what happens when the very architecture of a market is destabilized by hidden information.
And to make this hyper-relevant for your exam prep, we are keeping the 2025 IES question on the von Neumann-Morgenstern theorem and the 2023 question on adverse selection versus moral hazard right in our crosshairs.
But we aren't just going to read you textbook definitions. That's not how you actually learn this stuff.
No, definitely not. We are going to build the underlying architecture of human decision-making from the ground up.
Okay, let's unpack this. Before we can even look at a complex market failure, like that used car lot, we have to look at the individual.
Right, the micro level.
Yeah. How does one single rational human being make a choice when the outcome is uncertain?
Well, historically, economists really struggled with this, like a lot. For a long time, they just assumed people calculated the mathematical average of a gamble and picked the highest number.
Just raw math.
Yeah, the expected monetary value. But that didn't match reality at all. Because if people only cared about the mathematical average, the expected monetary value, well, nobody would ever buy insurance.
Oh, because on average, you lose money on insurance. Exactly. The insurance company has to make a profit, so the expected monetary value for the buyer is technically negative. And on the flip side, if people only cared about raw expected value, everyone would just spend their entire paycheck on lottery tickets.
Which, some people do, but broadly speaking, the theory was broken.
It was. The paradigm didn't really shift until 1944. That's when John von Neumann, who was, frankly, one of the most brilliant mathematicians of the 20th century, and this economist, Oscar Morgenstern, published their work on game theory.
And they weren't even just looking at economics. Right?
No, they needed a way to model how people make decisions in poker, and by extension, how people make decisions in war and obviously in economics.
So they introduced the expected utility hypothesis. And for you listening, the core insight here is that a rational individual doesn't just look at the absolute best case scenario. And they don't just look at the raw dollar amount either.
No, they weigh it.
Right. They weigh the subjective utility of a specific outcome by the mathematical probability of that outcome actually occurring. So you're valuing the prize, but you're scaling that value by your realistic chances of actually capturing it.
And that concept right there is the beating heart of the VNM Expected Utility theorem. But von Neumann and Morgenstern, they didn't just want to propose a neat theory. They wanted to mathematically prove that human preferences over risky lotteries could be consistent.
That they could actually be rational.
Yes. To do that, they had to establish a foundation. So they built their theorem on 4 fundamental axioms. And you should think of these axioms as like the minimum system requirements for a rational human mind facing uncertainty.
Okay, so if we are building a rational human from scratch for the exam, What is the absolute baseline requirement? I assume it's the ability to actually make a choice in the first place. Like, you can't model someone having a paralyzing existential crisis in the cereal aisle.
Exactly. That is the first axiom. Completeness. So, if you present our rational consumer with any two risky lotteries, let's just call them Gamble A and Gamble B, the consumer can always compute a preference.
Always.
Always. They will prefer A to B, they will prefer B to A, or they will be perfectly indifferent between the two. They never look at the options and simply say, I have no idea how to compare these. They always have a ranking.
Right, like standing in the cereal aisle. You might not care whether you get the cornflakes or the bran, but you can definitely establish that indifference. You don't just, like, freeze until the grocery store closes.
Yeah, your brain processes the comparison.
Mm-hmm.
So that's completeness. But making a choice isn't enough. The choices have to relate to one another logically, which leads us to the second axiom, transitivity.
Oh, I love transitivity.
It's crucial. Transitivity ensures your choices don't contradict each other across time or across multiple options. So if you tell me you prefer Gamble A over Gamble B, and then you tell me you prefer Gamble B over Gamble C.
It absolutely must follow that I prefer Gamble A over Gamble C.
Right. If your preferences loop back around, like if you suddenly say you actually prefer C over A,
yeah,
well, your logic is completely circular.
And looking at our source notes from JNU, a circular preference in economics is catastrophic because it leads to what they call the money pump.
Yes, the money pump. It's brilliant.
Let's visualize that for the listener.
Yeah.
Let's say I have Gamble C, and you prefer B over C, right? So I offer to trade you B for C, but I charge you a 1-cent transaction fee.
Okay, I accept because I like B more than C. So now I have B.
But wait, you prefer A over B, so I offer to trade you A for B for another penny.
Again, I accept. Now I have A.
But because your preferences are broken and circular, you actually prefer C over A. So I trade you C for A, charging you another penny. We are right back where we started. I am 3 cents richer, and I can literally spin you in this circle until you are completely bankrupt.
Yeah, the money pump is the ultimate proof that transitivity is absolutely required for survival in a market. If you don't have it, you get exploited instantly.
Okay, so we have completeness and transitivity. What's the third axiom?
The third is independence, and this one deals with outside noise. It basically states that your preference between two lotteries shouldn't change just because I mix a completely irrelevant third lottery into both of them at the exact same probability.
Let me make sure I'm getting this. So if I naturally prefer a guaranteed cup of coffee over a guaranteed cup of tea, my underlying preference shouldn't suddenly flip just because you introduce a coin toss.
Give me an example of the toss.
Like if you say, heads, you get your preferred drink, tails, you get a donut. I am still going to choose the coffee donut gamble over the tea donut gamble.
Exactly.
Because the presence of the donut mixed equally into both scenarios doesn't magically make tea taste better to me.
That is a perfect way to frame it. The noise just cancels itself out. The donut is mathematically irrelevant to your choice between coffee and tea.
Makes total sense.
So now we arrive at the fourth axiom, and this is the one that builds the actual bridge to the mathematical proof. Continuity.
Okay, this is where I have to push back a little bit, because reading through the notes on this, the continuity axiom just seems to break reality.
How so?
Well, it claims that if you have 3 outcomes ranked in order, the best, the middle, and the worst, there must exist some specific probability that makes you perfectly indifferent between taking the middle option for certain or taking a gamble between the absolute best and the absolute worst.
That is the exact definition, yeah.
But let's apply that to a really high-stakes scenario. Let's say the best outcome is winning $10,000. The middle outcome is winning $1 single dollar. And the absolute worst outcome is, like, immediate painful death.
Okay, extreme, but let's go with it.
Does the continuity axiom actually argue that a rational human being would accept a non-zero probability of death just for the chance to win 10 grand instead of safely taking their guaranteed $1? Because honestly, that sounds like the definition of irrational.
It sounds horrifying when you put it like that. But wait until you observe how humans actually live their everyday lives. Let's step away from the abstract laboratory gamble. Imagine you find out a store, maybe a few towns over, is selling a new laptop for an incredible discount. Let's say it saves you $1,000.
Okay.
So you decide to get in your car and drive onto the highway to go get it.
Sure, people do that all the time.
Right. But by merging onto a high-speed highway, you are voluntarily accepting a non-zero probability of a fatal car crash. That is literally the worst possible outcome.
Oh.
The guaranteed middle outcome was simply staying home, perfectly safe, but, not getting the discount. You traded a microscopic chance of death, combined with a high chance of a $1,000 discount over the absolute certainty of the status quo.
Oh, wow.
We do this every single time we cross a busy street to pick up a dropped coin or, board a plane for a vacation. The probability of the worst outcome just has to be vanishingly small. But it's never zero.
When you frame it as a macroscopic daily action rather than just a math problem, the logic really is inescapable. Like, we constantly accept microscopic risks of ruin for marginal gains. Okay, I concede. The continuity axiom holds up.
It's robust.
So, if our consumer satisfies completeness, transitivity, independence, and continuity, von Neumann and Morgenstern proved we can mathematically map their mind.
Yes, we can map their utility function.
Let's walk the listener through that derivation step by step, but without getting bogged down in the symbolic alphabet soup.
Definitely. The derivation is actually a masterclass in elegant architecture. We start by establishing boundaries. We take the absolute best outcome in our universe of choices, and we assign it an arbitrary maximum utility value. Let's just call it 1.
Okay, that's our ceiling.
Right. Then we take the absolute worst outcome and assign it the minimum utility value. Let's call it 0.
So we have built the ceiling and the floor. Everything else in this universe has to exist between 0 and 1.
Exactly. Now, what do we do with an outcome that falls somewhere in the middle? Let's say winning $50. Because we just proved the continuity axiom, we know for a fact that there is some specific probability, let's call it P, that makes our consumer shrug their shoulders and say, I am perfectly indifferent between taking the $50 for certain or taking a gamble that gives me a P chance of the best outcome and a 1 minus P chance of the worst outcome.
So we basically find the tipping point, the exact percentage chance of hitting the jackpot that makes the sure thing feel equally attractive.
And here is the absolute stroke of genius from VNM.
Yeah.
They defined the utility of that middle outcome as simply equal to that probability.
Wait, really? Just a one-to-one mapping?
Yes. If you need a 60% chance of the best outcome to be indifferent, then the utility index of that middle option is literally 0.6. By repeating this process, mapping every possible outcome to a probability, they proved that a rational agent's preferences can be represented by a linear mathematical function.
So for your exam notes, if you're listening and writing this down, here is the plain English translation of the theorem. The expected utility of a lottery equals the probability of the good outcome times the utility of the good outcome plus the probability of the bad outcome times the utility of the bad outcome.
Perfect.
You just multiply the likelihood of the event by the utility of the event, and you add up all the branches of the decision tree.
And it proves unequivocally that rational agents maximize expected utility, not just expected monetary value. They process the joy or the pain of the money scaled by the odds.
Let's translate this directly to the 2025 exam benchmark we talked about at the top of the show. The question asked you to compute and rank expected utilities to demonstrate stochastic dominance.
Well, let's break that down.
Let's frame their data as a real-world scenario. Imagine you have 4 different startup investment opportunities. Option A1 offers a 40% chance of delivering an outcome with a utility index of 50.
Okay, so we just do the math. We multiply the probability by the utility. 0.4 times 50 gives us an expected utility of 20.0 for option A1.
Option A2 is a slightly riskier startup. It has a 30% chance of hitting an outcome with an 80 utility index.
0.3 times 80 yields an expected utility of 24.0.
Option A3 is more of a long shot, a 20% chance of a 60 utility outcome.
So 0.2 times 60 is an expected utility of 12.0.
And finally, option A4 is like the ultimate moonshot, a 10% chance of a massive 90 utility payout.
Right, so 0.1 times 90 gives an expected utility of just 9.0.
Okay, so if we rank these investments based on our calculations, A2 dominates at 24.0, then A1 at 20.0, then A3 at 12.0, and A4 is dead last at 9.0. But look at A4 for a second. It had the highest absolute payout, a peak utility of 90. If someone was just chasing the biggest number, they would throw all their money at A4.
What's fascinating here is how that completely exposes the flaw in ignoring probability. Yeah. This is stochastic preference ranking in action. A rational agent weights that massive payout against the abysmal 10% odds and realizes A4 is actually the worst possible choice on the board.
Because the odds are just too low.
Exactly. The probability weighting mathematically predicts why people walk away from massive but highly unlikely payoffs in favor of more stable, moderate returns. It explains the foundational concept of risk aversion,
which forms, honestly, the perfect conceptual bridge to our next layer of analysis. The VNM theorem proves we use a probability-weighted utility curve. what happens inside our heads when we actually look at that curve, because a thrill-seeking day trader and a cautious retiree clearly don't process risk the exact same way.
No, definitely not.
How does the shape of the curve reveal a person's psychological attitude toward risk?
Well, it's all about the curvature. When we graph wealth on the horizontal axis and total utility on the vertical axis, a risk averter will always have a strictly concave utility curve.
Concave, so it's bowed outward, shaped kind of like the slope of a hill.
Exactly, meaning it starts off rising incredibly fast, but the further to the right you go, meaning the richer you get, the flatter that slope becomes.
This visualizes the law of diminishing marginal utility of wealth, right?
Yes. Think about your first $10,000. That money is life-changing. It pays for shelter, food, basic survival. The utility spike is massive.
Huge.
But if you already have $50 million sitting in a bank, earning another $10,000 barely registers emotionally. It might just be a rounding error on your accountant's spreadsheet. The utility gained is absolutely minuscule.
Okay, I understand the deceleration of joy, but how does that deceleration mechanically make someone hate risk?
Because it creates an asymmetry between pain and joy. This is crucial for the exam. For a risk averter, the psychological pain of losing $1 is strictly greater than the psychological joy of gaining that exact same dollar.
Wait, really? Can you give an example?
Let's say you have $100,000, putting you right in the middle of that curving slope on our graph. If you lose $50,000, you slide backward down the steepest part of the cliff. That loss of utility is devastating.
It's a huge drop.
But if you win $50,000, you move forward into the flatter part of the curve. The extra utility is nice, but it doesn't match the intensity of the potential loss. The curve has already flattened out.
So if I offer you a perfectly fair coin flip heads, I give you 10 grand, tails you give me 10 grand, you will reject it.
Every time.
The expected monetary value is exactly 0, so the math says it's a wash. But because the downside plunges you deeper into negative utility than the upside lifts you into positive utility, the expected utility is actually negative. You walk away.
Exactly. That asymmetry drives the behavior.
So we know they hate risk. But economics is a science of measurement. How do we quantify exactly how much they hate it?
We use two critical benchmarks, the certainty equivalent and the risk premium.
Okay, let's define those conversationally.
Let's imagine you are holding a lottery ticket that gives you a 50% chance of winning $100,000 and a 50% chance of winning nothing. Mathematically, the expected value of that ticket is $50,000.
But because of the pain-joy asymmetry we just talked about, a risk averter is absolutely terrified of the 50% chance of getting nothing.
Right, so I approach you and offer to buy the ticket from you for guaranteed cash. The certainty equivalent is the exact risk-free dollar amount where you say, I am perfectly indifferent between taking this guaranteed cash and taking my chances with the lottery ticket.
And for a risk averter, this number is always going to be lower than the mathematical expected value.
Always. You might accept, say, $40,000 guaranteed.
Which means I just give up $10,000 of expected mathematical value.
And that $10,000 is the risk premium. It is the amount of expected wealth you are voluntarily leaving on the table just to avoid the anxiety of the gamble. It is literally the price tag you put on your own peace of mind.
That is a phenomenal way to conceptualize it, the price of peace of mind. But you know the DSE and JNU examiners want more than just concepts. They want calculus.
Of course they do.
How do we extract a precise index of this aversion from the math of the curve itself?
This was the major breakthrough achieved independently by economists Kenneth Arrow and John Pratt back in the 1960s. They developed a way to measure the exact degree of curvature of the utility function at any specific level of wealth. They gave us the absolute risk aversion measure, or ARA, and the relative risk aversion measure, or RRA.
Okay, let me see if I can deduce the math translation based on what we've already established.
Go for it.
You said the curve is concave. The first derivative of the utility function is the marginal utility of wealth, right?
Yes.
And more money is always better, so the first derivative must be a positive number.
Correct.
But the second derivative measures the acceleration or deceleration of that joy.
Yeah.
Because the curve is flattening out, the marginal utility is decelerating, so the second derivative must be a negative number.
Spot on. The rate of change is slowing down.
Okay, so the Arrow-Pratt formula for absolute risk aversion is the second derivative divided by the first derivative. But wait, if I divide a negative second derivative by a positive first derivative, the result is a negative number.
That's just how the math shakes out, yeah. Yes.
But we are trying to create an index of risk aversion, which should logically be positive. Is that why there is a negative sign planted at the very front of the Aeroprat formula?
That is the exact mechanical reason. The formula is the negative of the second derivative divided by the first derivative. That leading minus sign flips the negative quotient into a positive index of absolute risk aversion.
Oh, that is incredibly satisfying to unpack. It just clicks together. Okay, so we have ARA. What about relative risk aversion, the RRA? The source notes say it's just the ARA multiplied by the individual's total current wealth.
Yeah, simple multiplication.
But why do we need two different lenses to look at the exact same person's risk profile? Let's build a scenario to tease out the difference. Let's take a junior software developer who has exactly $10,000 to their name, and let's take a billionaire tech CEO.
A massive disparity in total wealth.
Right. Absolute risk aversion evaluates how your willingness to take a gamble changes if we keep the absolute dollar amount of the gamble fixed, but scale your wealth up and down. So if I approach both the junior developer and the billionaire with a coin flip, where they could win or lose exactly $1,000, their reactions will be wildly different.
Definitely. Empirically, human beings exhibit decreasing absolute risk aversion, or DERA. DERA, yeah. As you accumulate more wealth, a fixed dollar gamble becomes less threatening. To the junior developer, losing $1,000 is 10% of their entire net worth. It could mean missing rent. They are highly averse.
Understandably so.
But to the billionaire, losing $1,000 doesn't even qualify as a rounding error. They might take the gamble just for the entertainment value. As wealth increases, absolute risk aversion strictly decreases.
But relative risk aversion changes the parameters, doesn't it?
Yeah.
We no longer look at a fixed dollar amount. We look at a percentage of their total wealth.
Yes, the stakes shift.
So I approach both of them and say, I want you to flip a coin where you could win or lose exactly 20% of your entire net worth.
Now the psychology shifts entirely. The junior developer is risking $2,000. The billionaire is risking $200 million.
And economists generally assume constant relative risk aversion, or CRRA.
We do. Meaning that regardless of whether you have $10,000 or $10 billion in the bank, the psychological terror of risking 20% of everything you own remains remarkably constant.
Which explains so much about investing. It's why a middle-class family and a massive sovereign wealth fund might both allocate roughly the same percentage of their portfolio to safe bonds versus volatile tech stocks. The scale changes, but the proportional risk tolerance holds steady.
Exactly. That distinction, DERA versus CRRA, is just a conceptual goldmine for an essay question. It shows the examiner you understand not just the calculus, but the human behavior the calculus is trying to describe.
But here is where we have to take a massive structural pivot in the deep dive. Up until this very second, we have been discussing risk in a perfectly symmetrical environment.
Symmetrical meaning both sides know the odds.
Right. When the junior developer or the billionaire flips the coin, they know the odds are 50-50. When we evaluated those startup options earlier, we knew the exact probabilities of success. But what happens to the architecture of an economy when the probabilities aren't shared?
When it's not a fair coin toss.
Yeah. What happens when one person at the table is holding a mirror and can see your cards?
Well, this is the transition from uncertainty to information asymmetry. And this is where markets don't just fluctuate, they catastrophically fail. This is the direct focus of the 2023 IES question, differentiating adverse selection from moral hazard.
The fundamental problem here is that information itself is distributed unevenly, right? Creating this toxic environment where totally rational behavior actually destroys the market.
If we connect this to the bigger picture, it's about sequence. Let's start with adverse selection. If I am writing the exam definition, I am stating that this is an information asymmetry involving hidden characteristics that exist before any contract is signed or deal is made.
Before. That's the key word.
Yes. One party possesses inherent, unchangeable information about their own quality or risk profile that the other party simply cannot observe.
The defining paper on this concept is George Akerlof's The Market for Lemons, published in 1970. And honestly, the history of this paper is fascinating because it was actually rejected by 3 major economic journals before it was finally published.
Really? 3 of them?
Yeah. The editors thought his idea was either too trivial to matter or so profound that if it were true, the entire field of economics would be invalidated.
These classical economics just assumed perfect information.
Exactly. Akerlof came along and said, what if the buyer is flying blind? Let's walk through his mechanism using that used car lot scenario we opened the show with. We have a market with 2 types of used cars. We have the high-quality cars, the plums, which are genuinely worth $10,000. And we have the low-quality cars, the lemons, which have hidden engine defects and are only worth $2,000.
Crucially, the sellers know exactly what they have. They've driven the car, they've heard the transmission rattle, they have perfect information about their asset's characteristics. But the buyers, standing on the lot,
Completely clueless.
to them, every freshly washed car looks absolutely identical. They cannot distinguish a plum from a lemon.
So the buyer has to rely on probability. If they know the market is split 50-50 between plums and lemons, they run an expected value calculation. Half the time the car is worth 10 grand, half the time it's worth 2 grand. So the rational buyer says, I will not pay a penny more than the average value of $6,000. If I pay 10 grand and get a lemon, I'm ruined.
And that completely rational defensive calculation by the buyer acts as a wrecking ball to the market. What happens to the seller sitting in the high-quality plum? They know their car is genuinely worth $10,000, but the absolute highest bid the market will offer is $6,000. So what do?
They refuse to sell,
Right. They drive their plum off the lot and exit the market entirely.
leaving only the defective lemons behind on the lot.
Exactly. And the buyers aren't stupid. They observe the market. They realize that at a price point of $6,000, all the good cards have vanished. The probability of buying a lemon is no longer 50%. It is now 100%.
Oh, man. So the buyers revise their offer downward again, dropping it to $2,000.
The market physically unravels. Mutually beneficial trades for high-quality goods simply cannot occur because the hidden information acts as an impenetrable barrier.
And this doesn't just happen with cars. Think about modern dating apps. It is a textbook market for lemons.
How so? I mean, I see the connection, but break it down.
Well, everyone creates a profile that looks shiny and perfect. You can't observe the hidden characteristics, whether someone is genuinely kind, which would be a plum, or like toxic and manipulative, which is a lemon.
Okay, yeah.
Because buyers, meaning the people swiping have been burned by lemons before, they adopt defensive, low investment behavior. They don't send thoughtful messages. They just swipe mindlessly.
Yeah.
The high-quality people look at this toxic, low-effort environment and say, this isn't worth my time. They delete the app.
And who is left?
A concentrated pool of lemons.
It is a brilliant modern analogy for what economists call a socially inefficient pooling equilibrium. Both good and bad types are forced into the exact same pool, and because they are pooled together, the average price or experience is dragged down until the good types are completely driven out.
It's depressing, but mathematically sound.
It's the exact same architecture behind a health insurance death spiral, too. If an insurer can't see who is healthy and who is chronically ill, they charge a high average premium. The healthy people drop their coverage because it's too expensive, leaving a concentrated pool of sick patients.
Which forces the insurer to raise premiums even higher.
Right, driving out more healthy people until the insurer just goes bankrupt.
So that is adverse selection. The characteristic was hidden before the deal, but the 2023 question asks us to contrast that with moral hazard. How do the mechanics of the failure change here?
Moral hazard shifts the timeline entirely. It is defined as hidden actions taken after an agreement is made and the contract is signed.
After.
The asymmetry isn't about an innate characteristic, it's about unobservable behavior. It occurs when one party is insulated from the financial consequences of their actions, so they take excessive, reckless risks, knowing the other party is going to foot the bill.
This introduces the principal-agent problem, which is arguably the most pervasive friction in modern capitalism.
Absolutely. A principal hires an agent to perform a task or manage an asset, but their incentives do not align, and the principal cannot set up a 247 surveillance camera to monitor the agent. Give me a corporate example. The shareholders of a corporation are the principals. They want long-term, stable stock growth. The CEO is the agent. The CEO might realize their bonus is tied to short-term quarterly profits, so they slash the research and development budget, gutting the company's future, just to juice the stock price for 3 months before they parachute out.
The action was hidden, and the cost was borne by the principal.
Exactly.
Let's look at the ultimate historical example of moral hazard, the too-big-to-fail banking crisis of 2008.
Oh, perfect example.
The banks were the agents, and the government, backed by taxpayers, was the principal. The banks knew that if they made wildly risky bets on subprime mortgages and won, they got to keep billions in bonuses. But they also knew that if those bets exploded and brought down the global economy, the government would be forced to bail them out.
They were completely insulated from the downside.
So they accelerated their risk-taking.
It is the purest distillation of the concept. Or, Look at everyday insurance.
Yeah.
If I have a cheap car insurance policy that barely covers anything, I park under a streetlight, I double-check the locks, I drive the speed limit.
Be careful.
Very. But if I buy a platinum, zero-deductible policy that covers every scratch, no matter whose fault it is, maybe I park in the sketchy alley. Maybe I push the speed limit. My behavior fundamentally degrades because the financial penalty of a crash has been transferred to the insurance company.
Okay, so if we are distilling this for a high-scoring exam conclusion, adverse selection is a pricing distortion occurring before the deal, driven by unobservable types. Moral hazard is a behavioral distortion occurring after the deal, driven by unobservable actions.
Both trigger massive inefficiencies, but the underlying timeline and mechanics are completely distinct.
That is exactly how you need to articulate it. But this raises an existential question for economists. If asymmetric information naturally triggers death spirals and empty car lots, why hasn't the entire global economy ground to a halt? Why do insurance companies still exist? Why are people still trading?
Because biological and economic systems adapt. When a market is bleeding out from hidden information, mechanisms evolve to force that hidden data into the light. The economy literally patches its own bugs.
This brings us to the solutions,
Right.
signaling and screening.
The distinction here is about who makes the first move. If the market is failing, someone has to bridge the gap. If the party who holds the hidden secret acts first to voluntarily reveal it, we call that market signaling.
Okay, so the informed party signals.
Right. But if the uninformed party acts first to interrogate the market and uncover the secret, we call that screening.
Let's look at signaling first, using Michael Spence's Nobel-winning education model.
A classic.
We have an employer looking to hire. They face an adverse selection problem. They can't tell the high-ability, brilliant workers from the low-ability, lazy workers. In Spence's model, the informed party, the high-ability worker, takes the initiative. They need a way to separate themselves from the pack, so they acquire a signal, a master's degree from DSE or JNU, for instance.
But a signal only works if it meets a brutal, non-negotiable condition. It must be costly and credible. And in Spence's framework, costly does not just mean the tuition fee.
Right, because if it just cost money, a wealthy but low-ability worker could just buy the signal.
Exactly. The true cost is psychological effort, time, and intellectual agony.
The foundational assumption of Spence's math is that the marginal cost of acquiring the signal is strictly lower for the high-ability person than the low-ability person. The brilliant student can read the textbooks, pass the exams, and get the degree with a moderate amount of effort.
While the low-ability student would have to hire tutors, retake classes, suffer immense stress, and spend double the years to achieve the exact same piece of paper.
Therefore, the low-ability worker runs a cost-benefit analysis and decides, the agony of getting this degree is not worth the future wage bump. I will just take the lower-paying entry-level job.
But the high-ability worker runs the same analysis and concludes, I can clear this hurdle relatively easily. It is worth the investment.
So the employer simply sits back, observes who walks in with a degree, knows that only a high-ability worker could have survived the gauntlet, and hires them. The hidden characteristic has been revealed.
Yes, the market works again.
I have to pause here because this theory triggers an absolute crisis of faith regarding higher education.
Oh, I know where you're going with this.
Is Spence genuinely arguing that the classes, the lectures, the late-night study sessions, like none of it actually matters? Does the university teach a student anything that makes them more productive on the job? Or is the entire higher education system just an incredibly grueling, artificially expensive obstacle course designed solely to prove to a corporate HR department what the student already possessed before they even enrolled?
It is a sobering thought, isn't it? In the purest mathematical formulation of Spence's signaling model, human capital is not augmented by one single percentage point.
That's wild.
The education literally adds zero productive skills to the worker. It is entirely a sorting mechanism. The degree is just an elaborate, time-consuming way to flash a neon sign that says, I possess the innate grit and intelligence to survive this arbitrary trial.
Just to prove you can do it.
Now, in the real world, it's a mix. A civil engineering degree obviously teaches you how to build a bridge.
Right, you can't just signal your way through structural physics.
True. But Spence's model was designed to prove a profound point. Even if the education taught you absolutely nothing of value, the degree would still command a massive premium in the labor market purely because of its power as an information-revealing signal. It works precisely because it's painful to acquire.
That is a staggering realization. It completely reframes how we view credentials. Okay, so that is signaling. where the informed party takes the pain to prove their worth. What about screening? This is where the uninformed party refuses to fly blind and acts first to tease out the hidden information.
Let's look at the insurance company facing the dual nightmare of adverse selection and moral hazard. They don't know who is naturally reckless, and they can't monitor how people drive once the policy is signed.
Right.
If they just ask the customer, "Are you a good driver?" the customer will lie to get a cheaper rate. So the insurer designs an incentive contract to force the truth out. The most elegant screening mechanism is the deductible.
How does forcing a customer to pay the first $2,000 of a claim act as an interrogation?
Well, the insurer never offers just one policy. They offer a menu of choices. Contract A is the premium package. It costs a fortune every month, but it has a $0 deductible. If you scratch the bumper, they pay for it instantly. Contract B is the budget option. The monthly premium is dirt cheap, but it carries a massive $5,000 deductible. You have to pay out of pocket before the insurance ever kicks in.
They let the customer self-select their own trap?
Precisely. A high-risk driver, someone who knows they have a lead foot and a history of fender benders, looks at Contract B and panics. They know they're going to crash, so a $5,000 deductible would ruin them. They swallow their pride and voluntarily buy the expensive Contract A.
Wow. And the low-risk driver?
A low-risk, cautious driver looks at the exact same menu and thinks, "I haven't had a ticket in 10 years. I'm not going to crash. I will gladly accept the risk of the high deductible in order to save thousands on the monthly premiums."
It is brilliantly manipulative. By offering the menu, the uninformed party forces the informed party to sort themselves into their true risk categories based on their own self-interest.
And the beauty of the deductible is that it actively combats moral hazard at the exact same time.
Oh, because the person who took the high deductible now has skin in the game?
Yes. Even if they have insurance, they know a crash will cost them $5,000 out of pocket, so they keep their speed down and lock their doors. The behavior is regulated without a surveillance camera.
To tie all of this into a bow for the exam, you need to explicitly contrast the systemic outcomes of these scenarios. You need to define the pooling equilibrium versus the separating equilibrium.
Let's lay out the definitive contrast. A pooling equilibrium occurs when the market completely fails to overcome the asymmetric information. The uninformed party gives up and treats everyone high quality and low quality exactly the same.
They are lumped into a single murky pool.
Yes. As we saw with Akerlof's used cars and the dating apps, a pooling equilibrium is inherently toxic and socially inefficient because it drives the high-quality actors out of the market entirely. The average price is simply too low to sustain the good types.
Conversely, a separating equilibrium is achieved when the market successfully deploys a mechanism, either a costly signal from the informed party or a clever screening menu from the uninformed party.
The mechanism acts as a filter, forcing the different types to reveal their true nature. The high-ability workers endure the degree. The low-ability ones don't. The safe drivers take the deductible. The reckless ones don't.
The market successfully separates the agents, assigning accurate prices and contracts to each group. The information asymmetry is neutralized, and market efficiency is restored.
The fog lifts, and we are back to a functioning economy.
So we've traced an incredible arc today. We didn't just rattle off isolated vocabulary words. You can now trace the exact mathematical and logical lineage of a market. You know how a single individual uses the VNM axioms to calculate expected utility?
You know how their personal risk aversion curves that utility function?
You know how the economy fractures into adverse selection and moral hazard when those risks are hidden? And finally, you understand how signaling and screening can restore a separating equilibrium. You have successfully bridged individual microfoundations with macroeconomic market failures.
And to ensure you walk into that exam hall with absolute confidence, let's look at the historical data from the source stack and formally identify the 3 most likely patterns for the 2026 IES GE-01 Paper 2 exam.
Let's hear them.
Pattern number 1, the mathematical proof of rationality under risk. You must be prepared to state the 4 VNM axioms: completeness, transitivity, continuity, and independence. You need to explain the derivation of mapping arbitrary utilities to probabilities, and you must be able to calculate and rank expected utilities, explicitly noting that a rational agent uses stochastic dominance, not absolute peak payoffs, to make decisions.
Pattern number 2, the mechanics of market unraveling. Be ready to explain adverse selection using a concrete, real-world mechanism like Akerlof's market for lemons or a health insurance death spiral. You must clearly state that adverse selection is a pre-contractual hidden characteristic that naturally degrades into an inefficient pooling equilibrium where high-quality goods are driven out by average pricing.
And pattern number 3, resolving the failure. Distinguishing the mechanics of a separating equilibrium from a pooling equilibrium. Use Spence's education model to show how a costly signal from an informed party, or use insurance deductibles to show how a screening menu from an uninformed party forces agents to self-reveal their types. You must articulate how this transition restores market efficiency.
If you master those conceptual arcs, you are not just memorizing economics, you are understanding the hidden code of human interaction. You are going to dominate this section of the paper.
But before we sign off, I want to leave you with a final, slightly provocative thought based on our discussion of signaling. We established that in Spence's model, acquiring a degree is a grueling, expensive signal just to prove you are high quality, without necessarily adding any tangible skills.
The ultimate obstacle course.
If that model is even partially descriptive of reality, think about the state of our modern economy. We demand master's degrees for entry-level office jobs. We have endless certifications, boot camps, and unpaid internships. How much of our credential-obsessed society is actually creating productive value and building true human capital?
And how much of it is just a socially inefficient arms race?
Exactly. Are we actually getting smarter, or are we just forcing everyone to run faster and faster on a treadmill just to tread water in a pooling equilibrium?
That is a phenomenal question, and it casts a long shadow over every diploma hanging on a wall. It is something to chew on as you close your notebooks today. Thank you so much for joining us on this deep dive into consumer demand theory. We know the revision process is a marathon, and we are rooting for you. Best of luck on your GE-01 Paper 2 exam. You've got this.